Hi, Michael Yardney, and welcome to this week's Property Insider video. Being the beginning of the month, we take a deep dive into all the property data with Dr. Andrew Wilson, but before that we discuss the fact that now officially we're in recession. What does that mean, and what does it mean for our property markets? If you want to keep up to date with all the latest property news, please subscribe to this video channel. And if you'd like YouTube to keep you up to date when we have a new show each week, click the little bell icon. It's the beginning of another month, and that means it's time for our deep dive into property data to give you an insight into what's happening to our housing markets around Australia. But before we get this information from Dr. Andrew Wilson, I'm going to ask his thoughts about Australia's financial accounts and the announcement that we're now officially in recession. Welcome, Andrew.
Thanks very much, Michael. Yes, good day.
Well, it's official. We're in recession. As if we didn't know. Australia's economy fell 7% in the June quarter over those 3 months, down 6.3% over the year. So this now means we're officially in recession because we've had 2 quarters of decline, and the news is telling us it's the biggest decline on record over 60 years since World War II. But while we've officially moved into recession, it's through outside circumstances, but it's made the world's longest economic expansion finish with a bit of a bang, hasn't it? Andrew, it seems that the figures were a bit worse than many market commentators were expecting. The fall was even a bit greater than the Reserve Bank's forecast of a 6% fall in the June quarter.
Well, look, these things are always a little up in the air, Michael, before we get the official data from the ABS. Not sure it matters that much whether it was 6 or 7 or 8% fall in GDP. We knew it was coming, no surprises. Of course, the big contributor to the fall in GDP was private demand, which took 7.9% out of GDP. And that meant people obviously during the lockdown period weren't spending. So consumption, obviously lack of consumption, contributed mainly to that fall in GDP. Net imports were up by, or contributed 1% nearly off that. And the other major factor, and of course that was a result of, even though we've had a reasonable export performance with the lockdowns, imported goods were constrained. So that was, again, not a bad result, I suppose. The other point was net government saving. It obviously collapsed from a positive figure of over $1 billion to a negative figure of around $80 billion. And that's, of course, through the job seeker support packages. At the end of the day, we knew it was coming. There's certainly no surprise here. The level of the result, I'm not sure is significant or newsworthy at any degree. We need to be looking now at the real economy, and that, of course, is incomes and how that reflects employment. And I think the other point we should make, Michael, in terms of the GDP and its relevance is that normally, of course, GDP numbers get a response from the government and the Reserve Bank in terms of policy settings. We've already had the policy settings preempted from what we knew was going to be a bad figure, and that action has been taken. Of course, we've had cuts to interest rates down to basically zero. We've had massive government spending. We know that will continue in terms of the government spending packages. So we've sort of front-end loaded the policy position from the GDP before we even had the results. That's the difference this time around. The Reserve Bank's also undertaking continuous, it's constrained with its, because it can't go much lower with interest rates. It basically can't go any lower, but we're seeing it release some credit restrictions on banks. Banks have access to more low interest rate finance to be able to pass on to their customers, and the Reserve Bank continuing to buy through third-party treasury bonds. So, which just means that pushes downward pressure on interest rates. So yes, at the end of the day, we've got the policy levers having been pulled in position for monetary policy already, for fiscal policy already, and now we just have to move on with the recovery. And the issue to that is that we have the Victorian economy back into shutdown, and that's going to have a significant impact on the September quarter GDP when that comes out in 3 months' time, Michael.
Well, I think we've got to remember that these are the figures for the quarter, the 3 months finishing at the end of June. And for much of that, April, May, we were locked down, Andrew. We've sort of forgotten that. But the other interesting thing I read in there was that household income actually rose 2.2% during that quarter. Maybe it's related to government stimuluses. And similarly, unincorporated businesses enjoyed an increase in earnings as well. So hopefully that's going to flow through to the current quarter that we're actually almost through.
Yeah, that's right, Michael. And as you said, this data reflects the severity of 2 of those 3 months in the quarter where we were nationally in significant lockdown environment. We've moved out of that, all except Melbourne, of course, Victoria, which is back into a lockdown now, and things are moving on in other economies other than that Victorian state economy. And then that's where we've got to turn our focus, is the implications or the results from the Victorian economy over the next couple of months. We'll have those results in more real-time data with particularly the unemployment rate that comes out monthly. So it'll be interesting to see where that unemployment number falls for Victoria and Melbourne when we get the next data in 3 weeks' time. And we did see actually the Victorian unemployment rate fell with the last data over July, but that was because of a sharp fall in the number of people participating in the workforce acted to offset the fall in employment. So it's a journey, Michael. We're underway. I think we're in reasonable position going forward now everywhere except for Victoria. And the Victorian experience, unfortunately, will impact our GDP numbers over this quarter when they are released in 3 months' time. But as I said, this is all backward-looking data. We've got the policy positions in place. We know what was going to happen, and that will continue to be monitored by the governments and the Reserve Bank going forward. But we've taken the first steps forward, Michael. Let's not make any mistake about that. And that's about easing the shutdown restrictions and supporting those that have lost jobs and lost their incomes during the last 6 months.
Well, we're not downplaying how bad things are, but we should also, as you say, see that things are starting to improve. Now, let's get into the property data, because as we normally do at the beginning of the month, you give us a lot of data. And Andrew, in my mind, the property pessimists, they must be running around a bit confused at present. Well, I know we're 5-6 months into this coronavirus-led downturn, and while property values have eased a little bit, it's nothing like those horrendous forecasts people made in April or March. Annual price growth remains positive in most states. And even though there's weakness in Melbourne, other markets are showing moderating declines and, in fact, signs of stabilisation.
Yes, Michael, it seems to be deja vu all over again, does it not? You only have to look back a year to all the egg scraping that was going on then regarding ridiculous predictions of price crashes. We haven't got to that position yet. We're all now talking about next year with declines, or it's going to be a longer decline rather than a short, sharp decline in prices. We'll see how that pans out, but we've always been more positive here, as you know, Michael, in terms of the historical argument for the types of price crashes that were predicted. It's just a headline grabber. We know that. We all move on. And I'm still, as I said to you during our last show, Michael, that I think that we may even see some price growth in some of those capital city markets before the end of the year. And the trend is certainly getting very close to the positive end of the bargain, particularly in Sydney and Brisbane. And of course, Melbourne will continue to suffer with its shutdown environment. We're seeing that with the other data. But yes, even the Sydney market's now starting to move into, I guess, territory that must have the doomsayers gnashing their teeth again in terms of the prospect for prices growth this year.
We know, of course, that when we talk about the Sydney market or the Australian market, you've got to get much more granular, and there will be certain segments that are still going to suffer. But if we look at what happened last weekend with auction clearance rates, Sydney did very well, didn't they?
Yes, Michael, with our latest data, we can see Sydney had its second weekend over 70%, so consecutive weekends over 70%. 70% clearance rates are certainly moving into a seller's market, and numbers were down a little bit in terms of listings. We are taking our auction clearance rate results with a grain of salt, as we've discussed, Michael, because a lot of these are online auctions. However, the proportion of withdrawals are now starting to fall as well. In Sydney, they're not as high as they've been. So good news there for Sydney, and it does reflect the trend over the past month. If we look at Melbourne, however, we did see the first of the real declines in the Melbourne market. Melbourne numbers are falling in terms of the number of auctions, the high levels of withdrawals, and that, of course, pushed down the clearance rate into the 30s. We've got to understand this is all about withdrawal numbers rather than actual sales. So it's a little bit misleading, that 30% clearance rate, but other auction markets are doing quite well, Michael. Listing numbers are reasonable, and clearance rates are certainly looking to be in favour of sellers in those other markets. And the trends we can see quite clearly for Sydney and Melbourne. Sydney market on the upswing, and the Melbourne market has fallen away just on that last week, and that will continue to be constrained by the lockdown policies that preclude open air auctions and open for inspections. We look at every week, Michael, at the new listings data. That's been reasonably steady, just easing over the last couple of days. But interestingly enough, when we look at new listings data compared to last year, we are now starting to see a significant difference in the level of new listings coming into the market now compared to a year ago. And of course, as we've discussed, this is a reflection of that reviving market last year. At this time, through spring, we saw a lot of sellers coming back into the market after a quieter period, and we're certainly seeing a big difference from the listing numbers currently, new listings compared to a year ago, which won't be a lot of good news for the portals, who would now be suffering, I guess, from the prospect of even fewer listings in their business through spring, which will only be exacerbated by the shutdown in the Melbourne market. If we look at the individual capitals in terms of new listings, Sydney and Brisbane, Michael, are holding up quite well in terms of the new listing index. No surprise, Melbourne has fallen away quite sharply over the past 3 weeks in terms of new listings, quite low. And when we look at the relative position of each of the capital cities in terms of new listings compared to Sydney as a base, Melbourne's now well down, not just on Sydney, but also all the other capital city markets. Similar result, Michael, with the new sales index. So these are newly reported sales. Sydney holding at quite high levels compared to the last 2 or 3 months. Brisbane holding at quite a strong level as it has been over the past few weeks. However, no surprise, Melbourne down quite sharply. The relative position in terms of newly reported sales is quite similar to that of listings, with Melbourne well below Sydney and only higher than Adelaide at the moment for the number of new sales coming through. So I guess it's continuing the trend we've seen. It validates these measures, Michael, of market activity, because we do know, of course, the impact of the shutdown policies in Melbourne. This is revealed quite strongly in the data, with new listings and new sales falling away precipitously in Melbourne. But the other capital city markets, Michael, and this does reflect the price outcomes that have been reported, are tracking along quite reasonably now, and certainly moving through into what should be a reasonable spring selling season.
At the beginning of each month, various data houses bring out their median price indexes.
Yes.
You look at it in advance by looking at the asking prices.
Yes.
And looking back historically, your indexes have been very, very accurate in predicting what's moving forward. And once again, you're showing that there's really been minimal change in asking prices. And in some areas, it's even raising it a little bit.
That's right, Michael. I think that does reflect what we're seeing in the backward-looking sales data. There's not a lot of movement there. Markets have been quite stable in terms of the level of asking prices for both units and houses, Michael. And only some of the smaller markets have, as you suggested, had an increase. But those numbers can be a little volatile because of smaller observations. But no doubt the bigger markets are tracking quite steadily in terms of asking prices. And again, I think that validates the other measures that we have in terms of new listings and newly reported sales. Similarly, in rental markets, Michael, we're not seeing a lot of movement in rental markets. Again, the rents at this stage still reasonably steady, although no surprise, we're starting to see some weakness in unit rents in Melbourne and Sydney. And we know that the Melbourne and Sydney rental markets, particularly for inner city apartments, are being characterised at the moment by high levels of vacancies, in fact, record levels of vacancies for properties for rent in CBD Melbourne particularly, and inner suburban Sydney. And I think that's again reflected when we look at the vacancy rates, Michael, which are very interesting. We're still seeing quite high vacancy rates for units in Melbourne and Sydney, record level vacancy rates in Melbourne and Sydney for units. Not much relief there in sight. But the very interesting data we have, Michael, that we've been really discussing and tracking over recent months is this continued sharp decline in the vacancies for houses. And we've speculated on the reason for this, but there's no doubt that that's continuing. There is strong demand for house rentals at the moment in most capitals. Vacancies are falling. I think there's a couple of reasons behind that. A, lack of churn. People are staying put in their rental properties. And I think perhaps we're seeing some increased demand from those that are looking for larger properties. Perhaps the unit's not good enough for a home office and for living space as well. So, and it's across the board, Michael. Most capitals we're seeing recording a decline, a consistent decline in vacancies for houses. So again, the market's, I guess, not just the sale market, but the rental market is exposed to the issues that the coronavirus shutdown has presented. But certainly so far, in terms of prices, a stable outcome, and the forward-looking data gives us certainly optimism that we may see some price growth by the end of the year, and all things, of course, being equal in terms of managing the coronavirus issues. And all bets are off, no doubt about it, if unfortunately we would have to move back into the type of shutdowns that Victoria and the Melbourne market are experiencing at the moment, which no doubt have an impact on housing markets.
Well, when you look at those rental statistics and the vacancy rates, the very high vacancy rates, particularly in Melbourne and Sydney and in apartments, means it's unlikely that rents are going to go up for some time. In fact, they're going to go the other way. To find a tenant, you're going to have to drop your rent. But when you're looking at houses, Andrew, with those sort of very low vacancy rates in Melbourne, Sydney and Brisbane, in fact, all over Australia, including Perth, that would suggest that it could well be we're going to see some rental increases as the year moves on.
That's right, Michael. I can't see a change in the short term in terms of increased absorption of those vacant units or apartments in a suburban or in a city, Melbourne and Sydney. But no doubt that this is quite remarkable, the decline in houses listed for rent in most capital cities. And these are getting, once we start getting below 2%, Michael, we know that that starts putting upward pressure on rents. And the point is that the volume of houses for rent typically is much lower than apartments. So the choices aren't there. And also they tend to be out of suburban. And maybe that's another factor, is that people are no longer connected to having to be located close to the CBD for work because of the remote living or the remote work environment that's now spreading through our society, that they can now live further out from the CBD, enjoy a larger premises, and maybe that's part of what we're seeing as the increase in demand for houses for rent.
Well, lots of great data and well summarised. Thank you very much, Andrew.
Thank you,
Clearly,
Michael.
our housing markets are going to still face pressures, headwinds. It's not all over, and how long it all goes on for will depend, as you've said a couple of times, about how quickly we can reinvigorate our economy, especially consumer confidence. And a lot of that will have to do with how quickly we can get rid of those cases and second waves of COVID. So we'll be back every week to report on what's going on. But in summary, yes, we are in recession, but I liked what you said earlier on. So what? Let's just get on with life.
That's right, Michael. Let's start looking forward, not backward.
Well said. Thank you for your time, Andrew.
Thank you, Michael.